It is 3 days before Christmas, and you still need one more gift. You are standing beside a spinning rack of plastic cards under grocery store lights that make everything look slightly depressing. You do not know what this person wants, but you know they drink coffee, so you grab a $25 card. The cashier scans it. $25 leaves your bank account. The card slides into an envelope. No latte gets made. No food leaves a shelf. No employee has to clean anything. The company has your cash and still has every product it could have sold you. You think you just bought someone coffee. The company thinks you handed it a tiny interest-free loan. And your $25 card is about to enter a machine with 2 endings. Both are good for the store. A week later, the card belongs to you. You slide it into your wallet between an expired coupon and a receipt you will never read again. This time, you remember it. You enter the store planning to spend exactly $25, but the thing you want costs $31.75. You could leave, or you could add $6.75 of your own money. You tap the card. You pay the difference. The store has now collected the original $25 and pulled another $6.75 out of your pocket. Researchers studying gift card programs have noted that redemption can create incremental revenue when shoppers spend beyond the card's value. But something even more important happened before you paid. The card decided where you shopped. $25 in cash could have gone anywhere. Your card only worked at the company printed on the front. The person who bought it did not just give you money. They bought the store a future visit from you. From your side, the transaction is finished the moment the card changes hands. From the company's side, it has barely started. Accounting rules do not let the store call your $25 revenue immediately. It records a liability because it still owes somebody $25 of future products. But the cash is already inside the business. It can help pay suppliers, cover payroll, or sit on the balance sheet while your card waits in a wallet. The company completed the best half of the sale, getting paid, before completing the expensive half, delivering anything. If every card is redeemed, the company still owes the merchandise. Gift cards are not magical profit, but until redemption, the retailer gets something ordinary businesses fight for every day: time with your money. And nobody is paying you interest for waiting. Now rewind. This time, you do not remember the card. It survives 2 wallet cleanouts, moves into a kitchen drawer, and disappears beneath 3 batteries that may or may not work. 6 months pass. The company still has your cash. You still have its promise. Then you finally find the card and spend $21.83. $3.17 remain. Now the store has placed you inside a tiny trap. Drive back across town to rescue $3.17, probably by spending more, or decide that your time is worth more than the balance. If you return, the card can pull fresh money from your pocket. If you abandon it, the balance begins a different journey. Accountants have a name for value that is expected never to be redeemed: breakage. The company cannot simply look at your card tomorrow and declare the remaining balance free money. It studies years of redemption behavior. It estimates which balances are unlikely to return. It accounts for applicable unclaimed property laws. Then, it recognizes expected breakage over time as customers use other cards. Watch your $3.17. At first, it remains inside a box marked "We owe the customer." As time passes and the company's historical model predicts that a portion of balances like yours will never come back, some expected unused value can move into revenue. No additional drink gets poured. No extra shirt gets sewn. Time and human forgetfulness changed the accounting. That sounds like a clever side business. Then, Starbucks shows you what happens when the side business becomes a payment system. You download the Starbucks app because ordering ahead saves time. The app gives you a digital card. You load $25, Maybe you enable automatic reload so the balance fills itself when it gets low. The money can buy Starbucks products, but it generally cannot be withdrawn as cash. Starbucks says the balance earns no interest and is not FDIC insured, so this is not legally a bank account. But watch what the system does. You give Starbucks money before ordering. The app remembers your balance. Stars encourage your next purchase. A limited time challenge gives you a reason to return. Mobile ordering makes returning easier. Then the balance gets low and reloads. One small convenience becomes a loop. Load, order, earn, return, reload. And you are not alone. In the first quarter of fiscal 2025, customers loaded $3.523 billion onto Starbucks cards in the United States. Starbucks reported 34.6 million active U.S. rewards members. Those members represented 60% of spending dollars at U.S. company-operated stores. Imagine the scene from above. Millions of customers each hand Starbucks $10, $20, or $50. The individual deposits look harmless. Together, they become an enormous reservoir of prepaid spending that can only flow back through Starbucks. Across fiscal 2025, Starbucks recorded about $15.2 billion of new deferred value from card activations, reloads, and stars earned. Most flowed back out through redemptions. But at year-end, its stored value card and loyalty program balance still stood at roughly $1.75 billion. This is not a rewards feature sitting next to the coffee business. It is a payment system wrapped around the coffee business. Now return to your abandoned $3.17. Multiply it by thousands of cards, then millions. In fiscal 2025, Starbucks reported $222.4 million of breakage revenue across company-operated and licensed store revenue. $222.4 million recognized from value customers were not expected to use. The number is huge, but the business lesson is bigger. Breakage happens once. Behavior can keep paying. The app learns when you order, what you buy together, which offers bring you back, and how often you return. You receive convenience. Starbucks receives a prepaid relationship with data attached. A forgotten balance can become revenue one time. A customer trained to load and return can generate revenue again and again. There are limits. Federal rules generally require covered gift card funds to remain valid for at least 5 years. State unclaimed property laws can require some unused balances to be turned over rather than kept. Starbucks says its U.S. cards do not expire or lose value through service fees. Its filings say breakage estimates account for redemption behavior and required remittances under unclaimed property laws. So the company cannot declare every inactive dollar free money tomorrow. It has to wait, estimate, and follow the accounting rules. But the central bargain remains. You gave the company flexible cash. It gave you restricted store credit. You took the inconvenience. It received the time, the return visit, the data, and possibly the unused balance. That is why gift cards survive even though sending cash takes seconds. Cash is more useful to the person receiving it. Gift cards are more useful to the company receiving the cash. They transform a present into a commitment, a shopper into a returning customer, and forgotten change into an accounting event worth millions. So the next time a $25 card disappears into your wallet, remember what the business sees. Not plastic, not generosity, a tiny interest-free loan with a chance you will return and spend even more. And if a boring piece of plastic can build a machine this powerful, imagine what the businesses you use every day are hiding in their fine print. Subscribe for the hidden money machines behind ordinary businesses.